The Reserve Bank of Australia has just put out a grim warning to property investors. In this video, I want to go over how the banks are starting to tell their customers and investors to sell, and how property investors are especially at risk in this market right now. So I'm sure most of you know Australia has officially entered its deepest recession on record. But property prices haven't crashed yet, but the real pain is about to begin. The biggest losers of this market so far have been Melbourne, followed by Sydney. And Melbourne is down 4.6%, followed by Sydney down 3% since March. But all the stimulus that the government has provided to save the property market is now going to be withdrawn at the end of this month. JobKeeper is being reduced from its $1,500 a fortnight payment to $1,200 for full-timers. But the worst thing that's happening now is part-timers. Before this were getting the full $1,500 payment, and now they're going to have their pay cut in half, and it's going to be reduced to $750 a fortnight. Not only this, but the eligibility for businesses is being tightened, so a lot of businesses will have to let staff go as they no longer qualify. JobSeeker is also being reduced from $1,100 a fortnight to $800 a fortnight, and there's no more cash payments like the two $750 welfare payments that were sent to people on the dole or on Centrelink payments, and also the two $10,000 superannuation withdrawals are now finished. So with all this government stimulus that's been thrown into the economy, it has been able to keep the economy going, and it has made this recession not feel like a recession, but that is all about to change. This is having a big effect on the rental market, and the Reserve Bank of Australia raised this in their latest minutes, but it was kind of hidden, and it's something the media is not talking about, but it's putting a lot of property investors at risk, especially those that have multiple negatively geared properties. So let's have a look at what the RBA said, because they'll never say it straight, but they always leave clues and hints to what they think is really happening in the market, and also what they're planning to do in the future. The Reserve Bank noted in its meeting that the long-term rental market is being affected by Airbnbs coming onto the market and holiday and tourist accommodation coming onto the long-term rental market. Also, they're talking about that migration has stalled, so it's not picking up the extra dwellings like students and international students would normally pick up, and also there is a slow of household formation. The board noted that rental vacancies had risen substantially, especially in Melbourne and Sydney, and that rents are falling substantially in Melbourne and Sydney and even other parts of Australia, and this is likely to continue. The RBA also spoke about house prices and noted that prices in Melbourne and Sydney has been the most affected, but in the other capital city markets they've been least affected, and some other capital cities have even risen, so there's been a mixed result. Another shocking forecast that has come out that's going to have a big effect on the property market, because the property spookers always before were saying migration location will save us. That's the reason why property prices always go up. But the Treasury has put out a forecast where they expect migration to fall by 85%. In July, the Australian Bureau of Statistics put out their numbers, and for the first time in history since records began in 1972, rents for the quarter fell. So never before have rents fallen over a quarter. And so this is really showing how dire the situation is. Over the past 12 months, rents in Sydney for houses have fallen 8% and units 8.1% according to SQM research, followed by in Melbourne where units rents have fallen by 6% and Melbourne house rents have fallen by 1%. But where I live in Melbourne, I've seen much bigger rental drops for houses than 1%. Something that is also starting to happen that is quite alarming, according to SQM research, the banks are now signaling to customers that are under pressure that now may be a good time to sell. According to SQM research, some banks have said outright to customers that are under pressure and that have no way of repaying in the future that now is a good time to sell before prices decline further. SQM researcher Mr. Christopher said that if a lot of forced sales do come onto the market, this will be the real test for the market, and we may see prices and the market continue to weaken. He said, "It feels like now we're just in the calm before the storm, and the real pain is about to begin at the end of this month when the government stimulus starts to be withdrawn and the banks start having their 6-month check-in with customers, and they may tell some people that cannot repay that now may be a good time to sell." And he said it's hard to be bullish on the market right now. Members noted that in addition to weak household and business borrowing, credit had tightened since early in the year, reflecting the weak economic outlook for the future. Good Deeds Property Buyers Principal Veronica Morgan said that the glut of 1 and 2 bedroom apartments coming onto the market was also going to depress profits. She noted that this has been a problem for a long time, but because of Airbnb and students, they were able to fill that oversupply and cover up the problem. But now that the Airbnb market is gone and the student market is gone, this problem has really been revealed. This means there's going to be a high supply of apartments coming onto the market. There's low demand because a lot of these apartments are low quality, and also banks are going to say that these apartments are high risk, especially those high density apartments, and buyers will have trouble getting finance. Vacancy rates in Melbourne and the Adelaide CBD have skyrocketed according to SQM research, while the regional markets have had their tightest rental vacancies on record. This is due to a lot of the jobs drying up in the CBD and people wanting more space. Sydney and Brisbane CBDs are showing signs of improvement, with Sydney's vacancy rate at 12.9% and Brisbane at 11.4%. Vacancy rates in Sydney peaked at 13.2% in July and Brisbane peaked at 13% in July. So what all this research and data says in simple terms is that property investors are in big trouble with falling rents, especially those that are in negative equity, and now they're no longer able to cover all the expenses because of the falling rents, and we may see more forced sales come onto the market at the end of the year. Not only this, but another deterrent for people wanting to invest in property is the government has extended the eviction ban. So I'm not sure why you would want to buy an investment property right now when you have falling prices, falling rents, and if you get a tenant that's not paying, you can't even evict them. So the risk is really towards the upside and there's not much potential for capital gains. Evidence has also come out that there are many distressed homeowners wanting to sell in Melbourne right now but can't due to the restrictions. So we may see a lot of distressed properties come onto the market after the restrictions are eased, after October and early next year. But don't go anywhere. There was also some very, very important information that came out of the RBA's meeting about interest rates and how they're going to respond to the current economic crisis. Now, the RBA has hinted, and there is more pressure coming on the Reserve Bank of Australia to drop the cash rate from 0.25% to 0.1%. This means interest rates will be lower, but I'm not sure how a 15 basis points drop would help much, but obviously it's going to do better than leaving the cash rate right now, and it'll also increase confidence. Interest rates and lending standards are the biggest reason that causes house price growth or house price decline, not location. If interest rates drops, house prices rise, and if lending standards are loosened, house prices will rise also. This is why in 2016 to 2017 house prices rose so much, but then when there was a Banking Royal Commission in 2018 and 2019, interest rates didn't move and lending standards were really tightened, and this is why we saw a big decline in property prices. The RBA also announced they're going to increase their term funding facility, aka money printing, and what this means is that they offer cheap credit to the banks to pass on that cheap credit to home buyers and business owners. This is where the Reserve Bank lends money to the banks at an interest rate of just 0.25%. This is why we've seen home loans for fixed rate mortgages drop below 2%, and we've seen business loans fall all the way below 3%, and I even saw a business loan for 1.9%. The RBA has also done something called yield curve control, and that is where they buy government bonds so that they can keep interest rates low for the government, so the government can borrow cheaply and the government can spend more on fiscal policy like JobKeeper, JobSeeker and infrastructure spending. The RBA said it could expand its monetary easing, QE, quantitative easing, aka money printing program of buying government bonds from its 3 years to 5 years. So that means that interest rates will not only be cheap for a 3-year fixed loan, but we may see 5-year fixed loan interest rates drop as well. Now, another thing that's really alarming is the RBA is coming under pressure to intervene to make the Australian drop lower. What that means is your purchasing power will be diminished, where they could drop the Australian dollar, from what it is now, 73 cents to 65, who knows what they'll do, but they do want a lower Australian dollar, and that means your purchasing power will be weaker, and it means that items that come from overseas imports will increase and inflation will increase, meaning that the expenses for the everyday Australian would rise just so that they can increase the economy and GDP. The board also said that it still indicated that more work may be required, noting that they would consider how further monetary measures could support the recovery. This means that the Reserve Bank is knowing that what they're doing now is not enough. They could expand their money printing, and also negative interest rates, which they've said is off the table, could, if the situation doesn't get better, be put back on the table. So the future for property prices and the economy is still not looking good, and the test is only really going to begin at the end of this month, September, where the government stimulus is withdrawn, and also that the banks are going to start checking with their customers. And next year in March, all this stimulus is due to be withdrawn completely, and the banks are going to start expecting their customers to start repaying or having to sell. So if you think everything's all rosy, here's a kitten for you. But things are definitely not looking good, and it's better to prepare early now before things get bad next year. Now, there has been some speculation by the banks that house prices could rebound late 2021. I don't know if that could happen. Maybe there's some really steep falls between now and mid 2021. There could be, a dead cat bounce, or there could be a bounce in house prices. So I will continue to monitor the situation, keep you all informed. And hey, if I do see that prices do drop and some good value does come up, I'll let you all know. And hopefully we could get our dream house we've always wanted for a discount. For all my loyal viewers and subscribers still watching, you're awesome. And if you haven't, smash the like button for the holy YouTube algorithm. It really helps out the channel a lot. And if you haven't already, subscribe for more awesome content on property market updates and the Australian economy updates. And of course, I'll see you in the next video.